Question 1. An insured purchased a life insurance policy and named his wife as the primary beneficiary and his son as the contingent beneficiary. If the insured and his wife are both killed in a car accident, who will receive the policy proceeds? A. The insured's estate. B. The insured's son. C. The primary beneficiary's estate. D. The life insurance company. Answer: B. The insured's son. In a life insurance policy, a contingent beneficiary is designated to receive the policy proceeds if the primary beneficiary dies before or at the same time as the insured. Since both the insured and the primary beneficiary, the wife, died in the accident, the contingent beneficiary, the son, steps in to receive the death benefit. This ensures that the policy proceeds are distributed according to the insured's wishes even if the primary beneficiary is unable to receive them. Always designate a contingent beneficiary to avoid the death benefit going to the insured's estate, which can complicate distribution. Question 2. Which of the following statements about group life insurance is true? A. Participants receive individual policies. B. It requires individual evidence of insurability. C. The cost is based on the group's average age and gender. D. It usually has a cash value component. Answer: C. The cost is based on the group's average age and gender. Group life insurance is typically offered through an employer or association, providing coverage to a group of people under one master policy. The cost of group life insurance is determined by the overall risk characteristics of the group, such as the average age, gender, and occupation, rather than individual health or lifestyle factors. This averaging of risk allows for lower premiums and simplifies the underwriting process, making it a valuable employee benefit. Remember, group coverage is usually term insurance, meaning it does not accumulate cash value. Question 3. All of the following are common characteristics of a major medical expense policy except: A. High maximum limits. B. Deductibles. C. Coinsurance. D. First dollar coverage. Answer: D. First dollar coverage. Major medical expense policies are designed to cover catastrophic healthcare costs, featuring high maximum limits and requiring the insured to pay an initial deductible before benefits begin. After the deductible is met, coinsurance provisions usually apply, meaning the insurer and insured share covered expenses, typically 80/20. First dollar coverage, where the insurer pays from the very first dollar of expense, is characteristic of basic medical expense policies, not major medical. Understand that major medical policies are structured to manage significant financial risks, not routine small expenses. Question 4. Which life insurance policy is characterized by a flexible premium and an adjustable death benefit? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is a flexible premium, adjustable life insurance policy that offers policy owners the ability to increase or decrease the premium payments and the death benefit amount. Unlike whole life, which has fixed premiums and a guaranteed death benefit, universal life allows greater control over cash value accumulation and protection levels based on the insured's changing financial needs. This flexibility is a key distinguishing feature of universal life, making it adaptable over time. Question 5. An agent selling an annuity explains the potential for higher returns linked to a stock market index, but also warns about the risk of losing principal. Which type of annuity is being described? A. Fixed annuity. B. Variable annuity. C. Indexed annuity. D. Immediate annuity. Answer: B. Variable annuity. A variable annuity offers potential for higher returns linked to the performance of underlying investment subaccounts, such as stocks or bonds, but it also carries the risk of loss of principal. The variable nature refers to the fluctuating value of the annuity units based on the performance of these separate accounts. This type of annuity requires both a life insurance license and a securities license to sell, emphasizing its investment component and inherent market risk. Always explain the investment risks to clients considering a variable annuity. Question 6. The entire contract provision in a health insurance policy states that the policy, including endorsements and attached papers, constitutes the entire contract between the parties. What is the primary purpose of this provision? A. To allow the insurer to change policy terms at any time. B. To prevent the insurer from making changes to the policy after it is issued. C. To ensure that all agreements are in writing and attached to the policy. D. To allow the insured to make changes to the policy after it is issued. Answer: C. To ensure that all agreements are in writing and attached to the policy. The entire contract provision is crucial because it stipulates that the policy document, along with the application and any attached riders or endorsements, represents the complete and final agreement between the insurer and the policy owner. This provision prevents either party from introducing outside evidence or agreements that are not part of the written policy. It protects the insured by ensuring all promises and conditions are clearly stated within the policy, making sure no verbal agreements can be used to alter coverage. Question 7. Under the Affordable Care Act, ACA, what is a key feature related to pre-existing conditions? A. Insurers can deny coverage for pre-existing conditions. B. Insurers can charge higher premiums for pre-existing conditions. C. Insurers cannot deny coverage or charge more for pre-existing conditions. D. Pre-existing conditions are only covered after a 12-month waiting period. Answer: C. Insurers cannot deny coverage or charge more for pre-existing conditions. The Affordable Care Act, ACA, significantly reformed health insurance by prohibiting insurers from denying coverage or charging higher premiums based on an individual's pre-existing health conditions. This consumer protection ensures that people with chronic illnesses or past medical issues can obtain affordable health insurance. This provision removed a major barrier to healthcare access for millions of Americans, preventing insurers from discriminating based on health status. Question 8. An insured has a health insurance policy with a $500 deductible and an 80/20 coinsurance clause. If the insured incurs medical expenses of $3,000, how much will the insurance company pay? A. $2,000. B. $2,400. C. $2,500. D. $3,000. Answer: A. $2,000. To calculate the insurer's payment, first subtract the deductible from the total medical expenses. $3,000 to $500 equals $2,500. This $2,500 is the amount subject to coinsurance. The insurer then pays 80% of this amount, $2,500 asterisk 0.80 equals $2,000. The insured would be responsible for the $500 deductible plus 20% of the remaining $2,500, which is $500, for a total out-of-pocket expense of $1,000. Understanding deductibles and coinsurance is fundamental to comprehending how health insurance policies share costs. Question 9. Which of the following is considered the most restrictive type of health insurance policy renewability provision for the insured? A. Optionally renewable. B. Conditionally renewable. C. Guaranteed renewable. D. Non-cancelable. Answer: A. Optionally renewable. An optionally renewable policy provides the insurer with the right to refuse to renew the policy at the policy anniversary date, or to renew it but with increased premiums. This gives the insurer the most control and the least security to the insured among renewability provisions. In contrast, non-cancelable policies offer the most protection, guaranteeing renewal and premiums up to a certain age. Remember, the less control the insured has over renewal, the more restrictive the provision. Question 10. A policy owner misses a premium payment on their life insurance policy but dies shortly after. If the policy is still in force due to a specific provision, which provision would it most likely be? A. Reinstatement provision. B. Incontestability provision. C. Grace period provision. D. Free look provision. Answer: C. Grace period provision. The grace period provision allows a policy owner a specified number of days, usually 30 or 31, after the premium due date to pay an overdue premium without the policy lapsing. If the insured dies during this grace period, the death benefit will still be paid, though any unpaid premium may be deducted from the payout. This provision protects policy owners from accidental lapses due to a slight delay in payment. Always understand that the grace period is a safety net for timely premium payments. Question 11. All of the following are common exclusions found in a typical life insurance policy except A. War. B. Aviation, non-commercial. C. Suicide within the first 2 years. D. Hazardous occupations. Answer: D. Hazardous occupations. While hazardous occupations might lead to higher premiums or a modified policy, they are generally not an outright exclusion that prevents coverage in a life insurance policy. Common exclusions typically involve specific events or activities that are deemed too risky, such as death resulting from war, non-commercial aviation, e.g., private piloting, or suicide within the first 2 years of policy issuance. These exclusions are designed to limit the insurer's liability for highly unusual or self-inflicted risks. Question 12. A prospective insured intentionally misstates their age on a life insurance application. If the misstatement is discovered after the policy has been in force for several years and the insured dies, what will the insurer typically do? A. Deny the claim entirely. B. Pay the full death benefit. C. Adjust the death benefit to what the premium would have purchased at the correct age. D. Refund all premiums paid and cancel the policy. Answer: C. Adjust the death benefit to what the premium would have purchased at the correct age. The misstatement of age or gender provision in a life insurance policy states that if an applicant misstates their age or gender, the insurer will adjust the death benefit to the amount that the premium paid would have purchased at the correct age or gender. This provision prevents fraud while ensuring that the insurer receives adequate premium for the actual risk assumed. It's important to remember that the policy itself is not voided, only the benefit amount is adjusted. Question 13. Which type of health insurance plan typically requires policyholders to choose a primary care physician, PCP, within the network and obtain a referral to see a specialist? A. Preferred Provider Organization, PPO. B. Health Maintenance Organization, HMO. C. Point of Service, POS. D. Indemnity Plan. Answer: B. Health Maintenance Organization, HMO. A health maintenance organization, HMO, is characterized by its managed care approach, requiring members to select a primary care physician, PCP, from the HMO's network. The PCP acts as a gatekeeper, coordinating all care and providing referrals for specialist visits. While this structure offers cost savings, it limits choice of providers and requires referrals, differentiating it from more flexible plans like PPOs. Understanding the gatekeeper role is key to comprehending HMOs. Question 14. An individual receives a lump sum payment from a life insurance policy upon the death of the insured. How is this death benefit generally treated for tax purposes? A. It is fully taxable as ordinary income. B. It is partially taxable, depending on the recipient's income. C. It is generally received income tax-free by the beneficiary. D. It is subject to capital gains tax. Answer: C. It is generally received income tax-free by the beneficiary. Life insurance death benefits paid to a beneficiary in a lump sum are generally received free of federal income tax. This is a significant tax advantage of life insurance, providing financial relief to beneficiaries without additional tax burdens. While interest earned on the death benefit if held by the insurer is taxable, the principal death benefit itself is typically tax-exempt for the beneficiary. Question 15. The payor benefit rider in a juvenile life insurance policy provides which of the following? A. Waives future premiums if the insured child becomes disabled. B. Pays the death benefit if the policy owner dies. C. Waives future premiums if the payor, e.g., parent, becomes disabled or dies. D. Provides additional coverage for the child if the payor dies. Answer: C. Waives future premiums if the payor, e.g., parent, becomes disabled or dies. The payor benefit rider is specifically designed for juvenile life insurance policies and ensures that if the adult payor, the parent or guardian paying the premiums, becomes totally disabled or dies, the premiums on the child's policy will be waived until the child reaches a certain age, usually 21 or 25. This rider protects the policy's cash value growth and ensures the child's coverage continues even if the premium payor is no longer able to pay. It's a crucial safeguard for policies on minors. Question 16. What is the primary purpose of the incontestability clause in a life insurance policy? A. To allow the insurer to contest the policy at any time for fraud. B. To prevent the policy owner from making any changes to the policy. C. To limit the time an insurer can deny a claim based on misrepresentations in the application. D. To guarantee that the policy will never be cancelled by the insurer. Answer: C. To limit the time an insurer can deny a claim based on misrepresentations in the application. The incontestability clause typically states that after a policy has been in force for a specific period, usually 2 years, the insurer cannot deny a claim based on misrepresentations or concealments made by the insured in the application, even if they were fraudulent. This provision protects the beneficiary from an insurer attempting to deny a claim years after the policy was issued. It provides a level of security to the policy owner, ensuring the policy cannot be challenged indefinitely. Question 17. An individual wants a life insurance policy that offers lifelong coverage, a guaranteed cash value, and level premiums. Which type of policy would best meet these needs? A. Decreasing term life. B. Universal life. C. Whole life. D. Annually renewable term. Answer: C. Whole life. Whole life insurance is designed to provide lifelong coverage, meaning it remains in force for the insured's entire life, as long as premiums are paid. It features level premiums that remain constant throughout the policy's life and builds guaranteed cash value that accumulates on a tax-deferred basis. This policy is ideal for those seeking predictability and guaranteed benefits. Question 18. Under which circumstance would a hospital indemnity policy typically pay benefits? A. To reimburse specific medical bills for a hospital stay. B. As a lump sum or daily amount for each day the insured is hospitalized. C. Only for surgeries performed in a hospital. D. To cover the deductible of a major medical policy. Answer: B. As a lump sum or daily amount for each day the insured is hospitalized. A hospital indemnity policy is a supplemental health insurance plan that pays a fixed benefit amount, either as a lump sum or a daily payment, for each day the insured is confined in a hospital, regardless of the actual medical expenses incurred. This type of policy is not designed to reimburse specific medical bills but rather to provide a cash payout that the insured can use for any purpose, such as living expenses or lost income, during hospitalization. It provides a fixed benefit rather than expense reimbursement. Question 19. An insured is covered by a disability income policy with a 30-day elimination period. If the insured becomes disabled for 45 days, how many days of benefits will the policy pay? A. 15 days. B. 30 days. C. 45 days. D. 0 days. Answer: A. 15 days. The elimination period in a disability income policy is a waiting period after the onset of a disability during which no benefits are paid. It acts like a deductible, reducing the number of claims and preventing payment for short-term disabilities. In this scenario, the insured was disabled for 45 days, but the first 30 days are the elimination period, leaving 15 days for which benefits will be paid. 45 days to 30 days equals 15 days. Remember that the elimination period directly reduces the period for which benefits are payable. Question 20. Which of the following describes the free look provision in an insurance policy? A. The right of the insurer to review the policy before issuance. B. The right of the policy owner to return the policy for a full refund within a specified period. C. The right of the beneficiary to review the policy after the insured's death. D. The right of the agent to examine policy terms before selling. Answer. B. The right of the policy owner to return the policy for a full refund within a specified period. The free look provision, also known as the right to examine provision, allows the policy owner a specific period, typically 10 to 30 days, depending on the state, after delivery of the policy to review it and return it for a full refund of all premiums paid if they decide it's not suitable. This consumer protection ensures that individuals have time to fully understand their purchase and are not pressured into keeping a policy they don't want. It provides a risk-free period for policy review. Question 21. Which of the following is true regarding Medicare Part B? A. It is optional and primarily covers hospital inpatient services. B. It is mandatory for all Medicare beneficiaries and covers prescription drugs. C. It is optional and primarily covers physician services and outpatient care. D. It is free and automatically enrolls all individuals turning 65. Answer. C. It is optional and primarily covers physician services and outpatient care. Medicare Part B is the medical insurance component of Medicare, which is optional and requires beneficiaries to pay a monthly premium. It primarily covers physician services, outpatient hospital care, and other medical services not covered by Part A, such as durable medical equipment and some home health care. Understanding that Part B focuses on outpatient and physician care is key, while Part A covers inpatient hospital stays. Question 22. All of the following are typically considered parties to a life insurance contract except A. The insurer. B. The policy owner. C. The insured. D. The beneficiary. Answer. D. The beneficiary. While the beneficiary is designated to receive the death benefit, they are not considered a party to the life insurance contract itself in the same way the insurer, policy owner, and insured are. The contract is an agreement between the insurer and the policy owner, who may also be the insured. The beneficiary is simply named by the policy owner to receive benefits upon the insured's death and does not have rights in the contract until the insured dies. Question 23. An individual is seeking a health insurance policy that will cover their medical expenses for a short period, typically less than 1 year, between jobs. Which type of policy would be most suitable? A. Major medical. B. Short-term medical. C. Long-term care. D. Disability income. Answer. B. Short-term medical. Short-term medical insurance policies are designed to provide temporary health coverage for individuals who need immediate, limited coverage, such as those transitioning between jobs or waiting for other coverage to begin. These policies typically have lower premiums but often come with limitations on coverage for pre-existing conditions and may not meet the minimum essential coverage requirements of the Affordable Care Act. They are not intended as a long-term solution but rather a stopgap measure. Question 24. A life insurance policy includes a waiver of premium rider. If the insured becomes totally disabled, what does this rider typically provide? A. A lump sum payment to cover medical expenses. B. Continuation of the policy with no further premium payments required. C. An increase in the death benefit amount. D. A partial refund of premiums paid. Answer: B. Continuation of the policy with no further premium payments required. The waiver of premium rider is a valuable feature that, if the insured becomes totally disabled, relieves the policy owner of the obligation to pay premiums during the period of disability. This ensures that the life insurance policy remains in force and its cash value continues to grow, protecting the coverage without financial strain during a challenging time. It's an important rider that prevents a policy from lapsing due to disability. Question 25. Which characteristic best describes a stock insurance company? A. It is owned by its policyholders. B. It issues participating policies. C. It is operated for the benefit of its shareholders. D. It pays dividends to its policyholders. Answer: C. It is operated for the benefit of its shareholders. A stock insurance company is a commercial insurer that is owned by its stockholders, who purchase shares in the company. Its primary objective is to make a profit for these shareholders, and any dividends paid are typically distributed to these shareholders, not to policyholders. This contrasts with mutual insurance companies, which are owned by their policyholders and often issue participating policies that may pay dividends to them.